My name is Randolph Glanville, and it's my pleasure to be joined by Bruce Burnett. We'll be talking a little bit about crops, but first I'm going to talk a little bit about livestock. I've always been interested in the commodity markets, and I began really looking at the cattle market in June of 2003. And that may not mean anything to you unless you're in the cattle business, in which case I might remind you that on May 20th, 2003, unfortunately, Canada had its first case of BSE, and the border slammed shut, changing the face of the cattle market in Canada for the coming decade at least. I've listed a number of things on the slide here, and this is courtesy of our friend Jerry Clausen, who actually helped develop this deck on livestock. And you can see things such as food security, production, consumption, but also these wild card factors that often enter into the outlook for cattle, things like tariffs, things like currency movements, border issues, disease issues, and so on. So what I'm going to be talking about are some of the best guesses in terms of where things are headed, but there are plenty of unknowns in the cattle market. One of the first things that I would point out about the cattle market is that demand for beef is obviously produced from the beef cows and cattle is relatively inelastic. And what this means is that as prices go up, people want to keep buying beef. They don't simply stop buying beef because the price goes up from $1.50 to $1.75. They may switch from high cut steaks to lower end ground beef, but they do keep consuming. And this means that the relationship between economic activity, which puts money in people's pockets to spend, and beef consumption is very closely tied together. A stronger economy means stronger beef consumption, and the reverse is also true. The graph here shows U.S. live cattle futures from 1969 until approximately the early 1980s. And you see in here a couple of periods during which the price of live cattle futures is directly influenced by the activity taking place in the U.S. economy. And so when the U.S. economy is slow, beef consumption and therefore cattle prices tend to be relatively weak. The reverse is also true, as we see in terms of the price being relatively high when economic activity is strong. A couple of other economic cycles occurred more recently in the 2006 to 2025 timeframe. And we did have a couple of recessions in here and also a couple of periods of expansion. When the economy is weak, central banks and governments tend to do things like drop interest rates, and even in the case of the 2020 pandemic, hand out free money to get people spending again. And this tends to stimulate demand for beef and therefore higher cattle futures. The result is that when prices for live cattle futures are very high, cow-calf producers are getting a very strong signal. Produce more calves. The money is there if you have the calves to fatten up and eventually sell to the feedlots. And so what we see here is a graph showing the US calf crop, which is about 10 times as large as the Canadian crop. The US calf crop bottomed in 2024 and is expected to slowly increase moving into 2025 and 2026. At an earlier event, we had a question, what about Canadian numbers? The Canadian calf crop is about 3.5 million, roughly flat in 2024 and 2025. We'll probably see a little bit of growth in 2026. However, do note the US calf crop's about 10 times as large, meaning what happens in the US has a huge impact on the Canadian cattle market. All of this, of course, results in beef production, which tends to tighten up in the higher, stronger phases of the price cycle. And that's because when prices are high, producers tend to retain their cows, they retain their beef replacement heifers so that they can produce more calves. And in the short term, This actually further tightens the beef supply, leading to even stronger prices. Eventually, though, there is a flip side, and that will likely start to be felt moving into 2026, as beef production will slowly start to turn higher again. One factor which will help to fuel the increase in beef production is the availability of a large U.S. corn crop. This is something that Bruce will be talking about in a few moments, but the availability of cheap and plentiful corn will help fuel an increase in beef over time. In terms of feeder cattle futures, the short-term outlook remains quite positive moving into the fall. And our friend Jerry Clausen, who writes a column for the Western Producer, helped produce the graph on the screen. He remains quite optimistic moving into the fall feeder run. It's only later, though, moving into 2026, when warning signs will likely result in lower feeder cattle futures. So that wraps up the discussion on the cattle market. I'll now turn things over to Bruce. He's going to talk about crops.
Okay, I'm Bruce Burnett, and I've been an analyst with various grain companies as well as with Glacier Farm Media for about 30 plus years. Actually, it's more than 35 plus years, which is way too long. But it also means that I've forgotten a lot and I don't know too much anyway. So it's all new to me. So we'll talk about this year's crop. There's a bit of a sideways traveled get into Saskatoon, sort of via Lethbridge and other areas. So I'll talk a little bit about our crop, how it's handling things so far, and what our market expectations are. If you take a look at the map, pretty simple map. It's the percent of normal over the last 30 days. I made it before I went on the crop tour, so it doesn't contain some of the rains that we've recently had. But basically, if you take a look at it, the red areas are less than 40% of normal precipitation for the past 30 days. So that's certainly an issue in those areas that are red, specifically in the southern areas of the prairies. The areas of Manitoba that are red, some of the crop in Manitoba looks good, especially I would say south on the southern end. As you move further north in Manitoba in the growing areas, things become a little bit more desperate. As you move into Saskatchewan, southeastern Saskatchewan again looks good. Just have to say, both in Manitoba, Saskatchewan, and Alberta, I sort of conducted a poll. Nobody said they have too much rain. They want some rain. So we need to get some rain here over the next 2 to 3 weeks. An inch, 2 inches. If you're really greedy and are on the good side of the Lord, probably you get 3. But then it can stop. We'll be fine. We have enough moisture to get this crop through. To start to go downhill on the crop in south central Saskatchewan. I would say around Pangman, Ogama. And as you go further west, all the way to Lethbridge, conditions remain very tough. There are some areas that receive some scattered rains. So you'll see the odd field that looks okay. But basically, the crops are short. We're starting to see some baling going on because it just doesn't look like there's going to be enough forage for the cattle out there. So that's really, a tough situation. The crop that's most affected will be durum, because that's one of our chief durum areas. So our durum yields are going to be down from last year significantly. So that's I guess the bad news. That dryness continues into south of Lethbridge. As you move further north, let's say north of the South Saskatchewan River, things look a little bit better in some of those areas. Crops aren't fantastic, but they look sort of average as you move north. And in some areas, as you move between the central and northern areas, you get to some pockets that are really looking good. So we have a crop in Canada, in Western Canada right now, that looks good. In the extreme, in the center, in the extreme south, it looks bad. And actually up in the extreme north, we have some dry pockets too. Northern Saskatchewan, Peace River in Alberta, and the northern part of that's also dry. So I equate it to be an Oreo cookie. The yucky parts are on the outside, and the really good stuff is in the middle. And that's the way you can think of this year's crop. So anyway, looking at durum production itself, we're using a drop of 2.5 bushels an acre about from last year. And last year wasn't a great yield on the crop. It could be more than that. It depends on our finishing conditions. But basically, we planted more durum area this year, and we're going to get less durum out. So the market sort of knows this, but it doesn't know this. And I think on the grains, durum probably has the best potential to maintain and go higher the prices over the marketing year here. There's a number of fundamental factors in durum that are positive. The Mexicans are no longer in the export market this year, so they won't provide a lot of competition for us. The U.S. is expecting a crop, but not a big crop as well, so there's going to be demand from the U.S. as long as we escape tariffs on that. And then in the Mediterranean basin, conditions are okay, but there's no really big crop coming there that's going to alter demand that much. So basically, I think the durum demand is looking strong. We had a strong export program last year. There's no reason why we can't have a strong program this year. And I think as we tighten supplies in the country, we'll see rise in prices here as we go through this marketing year. Switch that around. The only negative part on the durum side is the fact the other grains really don't look that right, and that relates to the corn, as we were talking about. So switching to spring wheat, because we could grow spring wheat pretty well everywhere on the prairies. Yes, there's some in the south that doesn't look very good, but really in the center and northern areas, the wheat looks pretty good, and I'm expecting yields to be about the same as last year. So this assumes a better finishing condition this year, because the condition of the crop isn't quite as good as it was last year at this time, but at least we're not going to have the blast furnace that we saw, last year that burned off the heads as they were filling and that type of thing. So we're expecting a little bit better finishing conditions here. So we planted less spring wheat area, but the same yield as last year. Our production is going to go down as well. So we don't have a pile of spring wheat coming at us. We have strong demand for spring wheat. Record program this year, record program last year. In fact, the wheat, excluding durum this year, exports from Canada are about 1 million tons above last year's record. So we've moved a lot of spring wheat. So that's positive. That's the positive side. Another crop I'll talk about a little bit about is the barley. Things look even better for barley. Again, not as much concentrated in the south, more in the center and the north. We're expecting yields to be up a bushel and a half from last year on the barley side. A little bit higher area, not really a big change, but anyway, so we'll expect at least similar production to maybe a little bit higher this upcoming year on the barley. The chief problem with barley is this corn crop that we're talking about. The corn conditions look really, really good in the States. I'm currently using a yield for the corn crop of around 189 bushels an acre average. USDA is at 181 right now. If we get, even if I'm wrong by a mile, but still it's going to be higher than USDA's, we're looking at carryouts in the US of corn about 2.5 billion bushels. The other problem for the US is that their export markets are going to be a little bit more restricted this year. The reason for that is this very beautiful word called tariffs. They put tariffs on everything, and so a lot of their consuming countries that consume U.S. corn have tariffs put up against them right now. So again, not a lot of them are saying, no, I'm going to buy more corn next year. They're basically going to cut back on their imports of U.S. corn. So that means U.S. corn is going to be trying to go around, try to find a place for demand. We think in Western Canada, we're going to see some very cheap corn come up here throughout most of the next marketing year. So how low could corn prices go? My current estimate is we're going to see corn harvest lows probably drop into the US $3 per bushel range, which is about $1.20 below where the futures are at now for the December contract. So that's a concern. That's going to put pressure on the barley market. It also pressures wheat because all of the grain prices are somewhat related. We have very wide spreads for wheat right now. And so naturally, if corn drops $1, wheat's not going to drop by $1, but it's going to have a hard time rallying, and it probably will follow corn lower to some extent. That is not great news for the market. So in terms of wheat, we're looking for a flat market to a little bit lower. The last crop, well, I'm going to cover the last two crops here. The first one's canola. Canola probably has the most upside and the most downside of any crop that we grow on the prairies here right now. So, and again, it's because of that beautiful word tariffs. So where's the tariff situation right now? China's investigating canola seed imports on an anti-dumping basis. They have put tariffs on canola oil and canola meal. Canola oil and canola meal, although we do export to them, especially canola meal, not really a huge factor in the whole marketplace. The big concern would be if they would put tariffs on seed. I personally don't feel that we're going to see that happen. China needs the oil, the vegetable oil, and canola is a high oil content seed. They do not need meal, a lot of meal. They're already self-sufficient in meal. So they're going to probably need the canola here. So I would say the expedient thing for them to do is investigate and say no tariff. So that's probably good news there, but they could still do it. I'm not in direct line to Beijing or anything like this, so that could happen. The second thing is the tariffs down to the U.S. Now, it's not tariffs on canola seed that we're be worried about. It's on oil or meal. If we were to see tariffs come in against oil or meal going south, that create big problems for us because the U.S. is our largest customer for both meal and canola oil. So in that scenario, we see our crush plants would drop their bids dramatically, and they'd also slow production down of canola oil and meal. In other words, the crush would drop off here. So it's something to keep in mind. I'm much like the Chinese on that. I don't think that we're going to have a tariff situation like that with the U.S. I believe we will have an agreement. There will be a broad-based tariff, but it's not going to impact the ag markets directly like that. I don't think there'll be specific ag duties in this whole pile of tariff mess that we're in right now. So having said that, I think that the futures are going to trade on the November contract between $700 and $750 a ton. Marketing advice, basically, when it's moving higher and getting up closer to that upper limit, probably a good time to sell off a little bit because there is risk. And if you want to know what the risk looks like, just think back to February when you're sitting and things were looking okay for the canola market. And then we had the announcements of some of the tariffs, and we dropped about over $100 a ton in a matter of weeks. So something to just think, there's big downside here, risk. I don't think it's going to happen, but don't think it's going to happen doesn't pay the bills. If you get a good price, you probably hit it, sell a little bit. And then when the price goes down, you have to go back in and wait and then sell it again. If we remove all the tariff thoughts, and if pigs could fly, the prices probably should be more in the range of $725 to $775 on the board, on the canola board. And you could probably trade as high as $800 a ton if there were no concerns there. Because the veg oil demand is strong. It's strong from the biofuel sector, and that's where we're getting the demand increase in vegetable oils, and it's creating prices that are very, very high for vegetable oils. Quick comment on pulses. As I said about the lentil crop, yields are probably variable here. Some of the more northern lentil growing areas probably a little bit better, but down in the south, probably not great yield potential. We did plant more lentils this year, so therefore we'll probably see a bump in production. Peas, which are grown more in the central areas of the prairies, look really good this year. One of the best pea crops in the last while that I've seen. Sure, in some of the southern areas where they've tried some peas, didn't work out too well this year, but basically in the key central growing areas, we've got some very good yields coming. We planted more pea area, and so that's going to be a concern because we have a lot of production, and guess which tariff hurts us the most? It's the Chinese tariff on peas because they're our largest customer. They have tariffed peas, and so I don't see them changing that unless we get to an agreement with China here. And I'm not optimistic. I'm not pessimistic about it, but I think that this is probably going to be a slow wheel compared to maybe what happens with the U.S. So it's something we're going to have to be very, very concerned about. If you have increasing supplies and your chief market is gone, that leaves price direction basically lower, so flat to lower on peas. The other thing I would just say, even if we solve some of the tariff issues, it's not going to be a panacea for the markets. Soybean meal is trading at multiple year lows, like over 10-year lows. So on the future side, protein meals are in excess supply right now, and so that's causing issues in those markets and making it very, very cheap. Now, eventually, we will see the hogs and cattle and other animals that consume the protein meals basically use this up. But right now, there's negative pressure in those markets, and I really don't. Peas participate in that market. Excellent. I guess we'll entertain some questions now, Randolph. Anybody got some questions?
So you mentioned that beef is a very inelastic position. So inelastic also tends to equate to luxury goods. So do you think the fundamentals for beef longer term is it is going to be a luxury good, and you'll see other proteins like chicken and that continue to dominate that, and beef will be a smaller player?
Yeah, that's a great question. So the question is, given the relative inelasticity in beef demand and the high prices over time, will we see beef become more of a luxury good, and we'll see some of the demand displaced by other proteins, be it non-animal proteins or things like chicken, perhaps pork and other examples? I think one of the things about beef is that people simply like it, and so they're quite willing to pay for ground beef and various forms of beef. And we tend to see over time, there's a lot of talk, well, it'll be displaced by pork or things like that, and it rarely seems to actually occur in a large scale way. I do think that things like chicken have increased on the demand side over time, and certainly we've seen interest in non-animal sources of protein. But I would expect that what will happen is beef prices will reach high enough in short term that we will start to see some demand rationing at the higher level. But in the background, the increasing production that's coming eventually increase the supply, and the demand won't drop off too severely because the price will start to come back down. And so I think that's a reasonable outcome to expect. Any more questions?
I just to say, with the drought happening specifically, like for us, we know southern Saskatchewan, and I'm noticing a lot more guys getting out of cattle because of it and add to an age. If our herd numbers keep decreasing that way, even though like we have kept a few more heifers back, would that be enough to offset that it might slow the decrease in price for a while?
Yeah, that's a great question. So the question is, in parts of Saskatchewan and Alberta, for example, it remains very dry. And this has led to some dispersal sales of cattle, beef cows, and so on. In the short term, that's a short-term market factor in the local area. The issue is that there are parts of Canada and certainly parts of the United States which are now pretty conducive to seeing some expansion of the herd. And so given the larger numbers of the US being about 10 times as large as us in pure numbers of beef cattle, and then the availability of some better conditions in parts of Alberta, which is a particularly important cattle province, short-term, small geographic dislocations are likely to be overwhelmed by the larger supply coming from elsewhere? Great question, though.
So if I heard you guys correctly, this would be a good time to have a feedlot, or am I wrong in that? Because like we're a lot of cheap corn coming in, a lot of cheap meals out there. Feed mill cattle prices are high.
I was going to say, what's your risk appetite? Because, feeders aren't cheap. But yeah, we're looking at lower feed grain prices. That'll help out here in the feedlot industry itself. I don't think it will be a panacea for them. It'll give them maybe a few more quarters of profitable feeding before the profitability drops to negative.
Yeah, I would agree. I think we're in the stage for a feedlot where it's already high risk. You're paying a lot of money for feeder cattle, and yes, the corn is cheap. There's other feed available. But eventually, when the cycle turns, that's the danger point for a feedlot. And so most feedlots will have a risk management program to try to mitigate some of that downside risk that is certainly there now and will increase into 2026. Any additional questions? All right. Thank you very much for attending this One Beer Market Update. If you're watching on the internet, we will be back on at 2 o'clock from Ag in Motion. I would ask you to please exit at the side of the tent where JC is there, and please deposit your can in the recycling bin. Thank you very much. Enjoy the show.
Thanks.